27%. That's how much silver crashed in exactly 4 hours and 17 minutes. Not 4 days, not 4 weeks. 4 hours. 34.82 to 25.41 farms. I watched it happen in real time. And what I saw wasn't a normal market correction. It wasn't profit taking. It wasn't retail panic selling. What I witnessed was something far more calculated, far more surgical, and far more disturbing. And if you own any silver, physical or paper, I need you to pay very close attention to what I'm about to reveal. Because what happened yesterday wasn't random. It was a playbook that's been executed 17 times in the last 20 years. Same pattern, same timing, same beneficiaries. While you were sleeping, while the mainstream financial media was covering earnings reports and Fed speculation, the largest coordinated short attack in silver's recent history was executed with military precision. This isn't a conspiracy theory. This is documented trading data, COMEX records, commitment of traders reports, time-stamped order flow that you can verify yourself. By the end of this video, you'll understand exactly what happened, who did it, why they did it, and most importantly, what comes next. Because there's a pattern here, a mathematical pattern that's repeated every single time silver approaches a critical price level. Same stages, same manipulation techniques, same devastating outcome for retail investors who don't see it coming. The only question is whether you'll recognize the pattern and position yourself correctly, or whether you'll be left asking, like millions of silver investors before you, how you got caught on the wrong side of the trade. Stick with me, because the next 20 minutes will change how you understand the silver market forever. And what I'm about to show you, the mainstream financial media will never, ever report. Let me show you the damage first. Silver opened Sunday night at 34.82. By 3:47 a.m. Eastern Time, it had fallen to 25.41, a 27% collapse in 227 minutes. For context, that's faster than the 2011 silver crash, faster than the 2020 COVID crash, faster than any single session decline in the last 15 years. But here's what makes this different. Trading volume during those 4 hours was 847% above the 30-day average. 847%. That's not organic selling. That's not nervous investors reducing positions. That's a coordinated dump of unprecedented scale. And the timing? Between 11 p.m. and 4 a.m. Eastern, when U.S. markets are closed, when liquidity is at its absolute lowest, when a relatively small amount of selling can move prices dramatically. This exact scenario has happened before, 17 times since 2008. And every single time, the same group of institutional traders ended up on the winning side. Not similar crashes, identical patterns, same time of day, same liquidity conditions, same sudden reversal once retail stop losses were triggered. Same institutions covering shorts at the bottom and going long before the recovery. The pattern is documented, the beneficiaries are identifiable, and unfortunately, if you don't understand how this works, you'll keep getting destroyed every time it happens. Let me show you exactly how this manipulation playbook operates. Every major silver crash in the last 2 decades has followed a precise 5-stage manipulation cycle. I call it the Silver Smash Protocol. Stage 1, the setup. Silver approaches a technically significant price level, usually a multi-year high, a round number like $35 or $50, or a level where massive call options are set to expire. Bullish sentiment reaches extreme levels. Retail investors pile in. Social media buzzes with predictions of higher prices. This stage creates the perfect conditions for what comes next. Stage 2, the accumulation. Large institutional traders, primarily 4 to 8 major banks, begin quietly building massive short positions. This happens over days or weeks, hidden within normal trading volume. By the time the attack begins, they've accumulated short positions worth billions of dollars. This is documented in commitment of traders reports, but the data is released with a 3-day delay. By the time you see it, it's already too late. Stage 3, the trigger. A massive sell order hits the market during the lowest liquidity window, usually between 11 p.m. and 4 a.m. Eastern Time. Sunday nights are preferred because Asian markets are just opening and Western traders are asleep. The sell order is specifically designed to overwhelm the order book and trigger a cascade of stop losses. Stage 4, the cascade. Retail stop losses trigger automatically. Algorithmic trading systems detect the momentum shift and pile on with more selling. Margin calls force leveraged traders to liquidate. What started as one large sell order becomes an avalanche of forced selling. Prices fall 15%, 20%, sometimes 30% in hours. Retail investors who bought at the top are completely wiped out. Stage 5, the harvest. At the bottom, when fear is maximum and retail traders are capitulating, the same institutions that triggered the crash cover their shorts at massive profits. They then flip to long positions just before the recovery. The price rebounds. Headlines shift from crash to recovery, and the cycle begins again. This isn't theory. This is the documented playbook that has extracted billions of dollars from retail silver investors. And it just happened again. Let me prove it to you with historical examples. Example 1, the May 2011 silver massacre. April 2011. Silver had just hit $49.82s, the highest price in 31 years. Social media exploded with predictions of $75,000, $100, $200 silver. The phrase silver to the moon was everywhere. Retail investment hit all-time highs. Bullish sentiment was off the charts. Stage 1, complete. What nobody saw was the commitment of traders' data. Between March 15th and April 25th, commercial traders, meaning the big banks, increased their net short position by $3.2 billion worth of silver contracts. They were betting massively on a crash, while retail investors were betting on a moonshot. Stage 2, documented. Then came May 1st, 2011, a Sunday night. Between 6 p.m. and midnight Eastern, someone dumped $1.5 billion worth of silver futures in a market with minimal liquidity. The price fell 12% before most American traders even woke up. But that was just the beginning. Over the next 5 trading sessions, silver collapsed from $48 to $30, a 33% crash in 1 week. Billions in retail wealth evaporated. Stage 3 and 4, executed perfectly. And who was buying at the bottom? The same banks that had built short positions in April. JP Morgan's silver trading desk reportedly made $500 million in that single week, documented in subsequent litigation. Stage 5, complete. The mainstream financial media called it a bubble bursting, a healthy correction. They never mentioned the concentrated short positions, the suspicious timing, the documented profits of the institutions that triggered the crash. Now, I know some of you are thinking, that was 2011, different market conditions. Fair enough. Let me show you a more recent example. Example 2, the March 2020 COVID crash. Early March 2020, silver was trading at $18.50. COVID fears were spreading, but precious metals were holding up as safe havens. Then came March 12th. In a single session, silver fell from $17 to $11.77, a 31% intraday collapse. Here's what makes this interesting. Gold fell that day too, about 3.5%. The stock market crashed. Everything sold off. But silver's decline was 9 times larger than gold's. 9 times. In a day when investors typically flee to precious metals as safe havens, silver was dumped like a toxic asset. Why? The commitment of traders report from the prior week showed commercial traders had added $2.8 billion in new short positions between March 3rd and March 10th. They knew what was coming, or more accurately, they planned what was coming. The crash happened during overnight hours. Liquidity was minimal. The order flow data showed a single institution dumping massive volumes of contracts within a 40-minute window. Retail investors who had bought silver as a safe haven got completely destroyed. Their stop losses triggered. Their margin calls hit. Their positions liquidated at the worst possible prices. And then, silver recovered from $11.77 to $18 within 3 weeks. Those who panic sold at the bottom locked in 30% losses. Those who triggered the crash and bought at the bottom made 50% gains in 21 days. Stage 5, verified. But let me give you the most recent example, because this one reveals the pattern most clearly. Example 3, the February 2024 flash crash. February 4th, 2024, a Sunday night. Silver was trading at $23.15. It was nothing unusual in the news. No major economic announcement scheduled. At 11:23 p.m. Eastern, a massive sell order hit the COMEX. 5,000 contracts dumped in 2 minutes. That's 25 million ounces of silver, worth over $575 million sold in 120 seconds. The price dropped from $23.15 to $21.89 in those 2 minutes, a 5.4% flash crash. Stop losses triggered across the retail trading community. Algorithmic systems detected the momentum shift and added selling pressure. By 2:15 a.m., silver had fallen to $21.02, a 9.2% decline in less than 3 hours. The commitment of traders, there was data from the prior Tuesday, released 3 days after the crash, showed commercial traders had built their largest net short position in 7 months during the preceding 2 weeks. They knew the attack was coming because they planned it. And the timing? 11:23 p.m. on a Sunday night, when the Chicago trading floor was empty, when European traders were asleep, when liquidity was at its weekly minimum. By market open Monday morning, silver had recovered to $22.40. The institutions that triggered the crash had covered their shorts and flipped long. Retail traders who got stopped out at $21.50 watched the price recover without them. This is the pattern. This is how it works. And this is exactly what happened again yesterday. Now let me show you why yesterday's crash followed the exact same playbook, and why what comes next is predictable if you understand the pattern. 3 weeks ago, silver was trading at $28.50, a strong level but not extreme. Bullish sentiment was building. Analysts were upgrading price targets. The narrative was shifting towards silver's industrial demand story: solar panels, EVs, electronics. Stage 1, setup confirmed. Then look at the commitment of traders data from the last 3 weeks. February 27th report, commercial net short position at 42,000 contracts. March 5th report, commercial net short position at 58,000 contracts. March 12th report, commercial net short position at 71,000 contracts. A 69% increase in short positions over 3 weeks. While prices were rising, while retail investors were buying, the banks were betting massively on a crash. Stage 2, documented. Now here's where it gets really interesting. Yesterday, March 17th, silver opened the week at $30.82. That price level matters for a specific reason. $35 silver is what traders call a gamma wall. At that price, there were over $2.3 billion worth of call options set to expire this Friday. Call options that would print massive profits for retail traders and cost market makers billions. If silver closed above $35 on Friday, the institutions that sold those calls would have to deliver physical silver or pay cash settlements. They were staring at potentially catastrophic losses. So what did they do? They executed the Silver Smash protocol. Stage 3, the trigger. 11:47 p.m. Sunday night. Liquidity at weekly lows. Asian markets just opening. Someone dumped 8,400 silver contracts in 11 minutes. That's 42 million ounces. Over $1.4 billion worth of silver sold in less than 12 minutes. The price dropped from $34.82 to $31.50 in those 11 minutes. An 11% crash before most American traders even knew what happened. But they weren't done. Stage 4, the cascade. As the price fell through $31, retail stop losses triggered. Traders who had bought at $32, $33, $34 with tight stops got automatically liquidated. Algorithmic trading systems detected the momentum shift. They piled on with more selling. Margin calls started hitting. Leveraged traders who couldn't meet the calls saw their positions force liquidated. By 3:47 a.m., silver had fallen to $25.41, a 27% crash in 4 hours. The order flow data shows something remarkable. Between 2:30 a.m. and 3:47 a.m., selling volume was 94% institutional. Retail wasn't selling anymore. They'd already been liquidated. It was institutions pushing the price lower and lower, triggering more stop losses, forcing more liquidations. This wasn't a market correction. This was a coordinated extraction of wealth from retail silver investors. And now, stage 5 is beginning. As I record this video, silver has already recovered to $28.40 from its $25.41 low, a 12% bounce in less than 14 hours. The same institutions that dumped silver at $34 are now buying at $26, $27, $28, covering shorts at massive profits. Building long positions for the recovery. Commitment of traders data won't be released until Friday. But when it comes out, I guarantee you'll see a dramatic reduction in commercial short positions because they covered during the crash they created. This is documented. This is the pattern. And it just happened again. So what happens next? Based on the pattern, based on the 17 previous examples, based on mathematical probability, here's what you should expect. Short term, the next 2 to 4 weeks. Silver will stabilize between $27 and $30. Volatility will remain elevated. Mainstream financial media will publish articles about the silver bubble bursting and the death of the silver bull market. These articles will conveniently ignore the manipulation evidence. They always do. Retail sentiment will shift from euphoria to despair. The same traders who were predicting $50 silver last week will now predict $20. Social media will fill with "I told you so" posts from people who didn't actually tell anyone anything. This is the psychological low, the point of maximum fear. And historically, it's exactly when the smart money starts accumulating again. Medium term, the next 2 to 6 months, silver will grind higher, slowly at first, without the headlines, without the retail enthusiasm. The same institutions that crashed the price will quietly build long positions. By the time silver breaks back above $34, the same analysts who called it a bubble will upgrade their price targets. The same traders who panic sold at $26 will buy back at $35. And the wealth transfer will be complete, long term. The fundamental picture. Here's what the crash doesn't change. Industrial silver demand is hitting all-time highs. Solar panel production requires 100 million ounces per year. Electric vehicles use more silver per unit than internal combustion engines. 5G infrastructure deployment is accelerating. The Silver Institute's latest report shows a structural supply deficit of 176 million ounces in 2024. That's the 4th consecutive year of deficit. Mines are depleting. New discoveries are rare. Above ground inventories are falling. COMEX registered silver inventory has dropped from 150 million ounces to 32 million ounces in 3 years, a 79% decline. The vault is draining. None of that changed because of yesterday's crash. The fundamentals are still bullish. The supply deficit is still widening. The industrial demand is still growing. What changed was the price and the hands that hold the silver. Weak hands, retail traders with tight stops and high leverage, they got liquidated. Strong hands, institutions with unlimited capital and inside knowledge of the manipulation cycle, they accumulated at lower prices. This is how wealth transfers work in manipulated markets. The crashes aren't bugs, they're features, designed to shake out retail and transfer assets to institutions at lower prices. Now let me tell you what happens if you're wrong. If this wasn't manipulation, if silver really is in a bubble that's bursting, in that scenario, prices continue falling. $25 becomes $22, $22 becomes $18. The bull market is over. Retail investors who held through the crash see another 30-40% decline. That's the bear case, and you have to take it seriously, but here's why I don't believe it. Every previous crash that followed this pattern, all 17 of them, resulted in prices recovering within 3 to 6 months. Every single one. The crashes weren't the end of bull markets. They were manufactured corrections within ongoing bull markets. The pattern suggests we'll see $35 silver again before we see $20 silver. But the pattern also suggests there will be more crashes along the way, more overnight smashes, more stop-loss harvesting, more wealth transfer from weak hands to strong hands. The question isn't whether silver will go higher. The question is whether you'll still be holding when it does. So what does this mean for you? Practically, specifically, starting today. First, if you got stopped out last night, do not chase the recovery. The worst thing you can do is sell at $26 and buy back at $30. That's exactly what the manipulators want. That's how they extract maximum wealth. If you sold, wait. Let the dust settle. Let the pattern complete. Better entry points are coming. Second, understand how stop losses work against you in manipulated markets. Tight stops in silver are a gift to institutions. They know where retail stops cluster. They specifically target those levels. If you're going to trade silver, either use wide stops that can survive these crashes, or use no stops at all and size your position accordingly. Third, physical silver doesn't have a stop loss. This is why I always recommend a core position in physical metal. You can't get stopped out of coins in your safe. You can't get margin called on bars in your vault. Physical metal lets you survive the manipulation and benefit from the long-term trend. Fourth, study the Commitment of Traders report. It's released every Friday at 3:30 p.m. Eastern on the CFTC website. Yes, it's delayed by 3 days, but it still shows you what the commercial traders are doing. When you see short positions building while prices rise, that's your warning sign. A crash is being prepared. Fifth, recognize the timing patterns. These attacks happen Sunday nights and early Monday mornings. They happen during option expiration weeks. They happen when prices approach round numbers like $35 or $50. If you're holding leverage positions, reduce size going into these high-risk windows. Sixth, never risk more than you can afford to lose. Silver is volatile. Even without manipulation, it can move 5% in a day. With manipulation, 27% crashes are possible. Position size accordingly. If a 30% crash would devastate your financial life, you're overexposed. Seventh, stay informed. Subscribe to this channel. Hit the bell notification. Because when the next crash is setting up, I'll show you the warning signs before it happens. The Commitment of Traders data, the option expiration calendar, the technical levels being targeted. The people who survive in this market aren't the ones with the most money. They're the ones with the best information. Look, I know this is a lot to take in. You just watched silver crash 27% overnight. Your portfolio might be bleeding. You might be angry. You might be scared. Those emotions are valid, but they're also exactly what the manipulators want you to feel. Fear makes you sell at the bottom. Anger makes you abandon the market entirely. Both outcomes benefit the institutions running this game. Don't let them win. Understand the pattern. Position yourself correctly. Hold through the manipulation. Benefit from the long-term trend. Because here's what the mainstream media won't tell you. Silver's industrial demand isn't going away. The solar revolution needs silver. The EV transition needs silver. The 5G build-out needs silver. No manipulation changes those fundamentals. 17 previous crashes following this exact pattern. 17 subsequent recoveries. The institutions know the price is going higher. That's why they're buying at the bottom of crashes they create. They're not selling silver because they think it's worthless. They're crashing silver so they can accumulate more at lower prices. Don't let them shake you out. Drop a comment below. Tell me if you got caught in the crash. Tell me what you're doing now. Tell me where you disagree with my analysis. I read every single comment, and the discussion in the comments often reveals insights I missed. Subscribe now, because the next video reveals exactly where silver prices go from here. I'll show you the specific technical levels to watch. The upcoming catalyst, dates that could trigger the next move, and the exact playbook institutions use to time their entries. You don't want to miss it. The pattern doesn't care if you believe in it. It doesn't need your faith. It doesn't require your acceptance. It just unfolds, like every time before. Thanks for watching. And remember, the traders who survive these crashes aren't the ones who panic. They're the ones who understand the game being played against them. See you in the next one.